Have you ever wondered how to successfully fundraise for your startup? It all starts with understanding your funding needs. Imagine you're building a house. Would you start without knowing how many bricks you need, or what kind of foundation you're laying? Of course not. Similarly, in the world of startups, having a clear idea of how much funds you need and for what purpose is the cornerstone of your fundraising strategy. This is where a business plan comes into play. It's like your blueprint, detailing your funding needs. It outlines your startup's financial requirements, the purpose of the funds, and how they'll be allocated. It's not just about knowing the amount, but also understanding why you need it, and how it will drive your business forward. So before you dive into the sea of fundraising, take a moment to map out your needs. Remember, a clear understanding of your funding needs is the foundation of successful fundraising. Once you know your funding needs, it's time to develop a compelling story. Let's delve into the importance of this story. It's not just about weaving an engaging narrative, it's about getting potential investors to see your vision. Your story should highlight the problem your startup is seeking to solve, but not just any problem. It needs to be a problem that resonates, that's tangible and relatable. Then comes the uniqueness of your solution. What sets you apart from the rest? What makes your approach different, innovative, and more importantly, effective? Now, potential investors are not just buying into your solution, but also the potential market size. They want to know that your startup has the capacity to scale and deliver returns on their investment. In essence, your story should be a blend of passion, innovation, and potential. Remember, a compelling story can make the difference between a successful fundraising campaign and a failed one. After developing your story, it's time to build relationships and create a strong pitch deck. Building relationships with potential investors is akin to sowing seeds for a fruitful harvest. One way to foster these relationships is through networking events. These gatherings are teeming with individuals who are eager to invest in promising startups. Participate actively, share your compelling story, and express your passion for your startup. Yet, don't limit yourself to networking events. Introductions by mutual contacts can also open doors. If someone in your network knows an investor, don't hesitate to ask for an introduction. Remember, people tend to trust recommendations from those they already know. In this digital age, social media is a powerful tool for relationship building. Engage with potential investors on platforms like LinkedIn or Twitter. Share insightful posts about your industry, comment on their updates, and show genuine interest in their work. Now, let's move on to the creation of a strong pitch deck. A pitch deck is a brief presentation that gives investors an overview of your business. It's your opportunity to effectively communicate your startup's value proposition. Ensure your pitch deck is concise, yet comprehensive. It should cover key points like your business model, market analysis, financial projections, and team structure. Make sure to highlight your unique selling proposition. What sets your startup apart from the competition? Also, your pitch deck should tell a story. The story of your startup. Make it compelling. Make it memorable. Investors see countless pitch decks, so make yours stand out. Remember, your pitch deck is more than just a collection of slides. It's a reflection of your startup's vision, your team's commitment, and your potential for success. In conclusion, building relationships and having a strong pitch deck are critical steps in your fundraising journey. So, go out there, connect with people, and create a pitch deck that leaves a lasting impression. Your startup's future success depends on it. Now that you've built relationships and have a strong pitch deck, it's time to explore different funding sources. Let's begin with the people closest to you, your friends and family. They're often the first port of call for many entrepreneurs, and for good reason. They believe in you, they want you to succeed, and they're often willing to invest in your startup. But tread carefully. You wouldn't want to strain relationships over business matters. Next, consider bootstrapping. That's when you fund your startup using your own savings or reinvesting profits back into the business. It's a challenging but rewarding route, as it allows you to maintain full control over your startup. However, it may limit your growth if you don't have substantial personal resources. Crowdfunding is another option. Platforms like Kickstarter and Indiegogo allow you to present your idea to the public, and anyone who believes in your vision can contribute. It's a fantastic way to raise funds while simultaneously generating buzz for your startup. But remember, successful crowdfunding requires a compelling story and an engaging marketing strategy. Then we have angel investors. These are wealthy individuals who provide capital in exchange for equity or convertible debt. They bring not just money, but experience, mentorship, and sometimes industry connections. However, they do expect a return on their investment, so make sure your startup has strong growth potential. Lastly, venture capitalists. These are professional investment firms that invest large sums in startups with high growth potential. They can provide substantial funding and invaluable advice, but they usually demand a significant stake in the company and a say in strategic decisions. Each of these funding sources comes with its own set of pros and cons, and what works best will depend on the nature of your startup, your personal circumstances, and your long-term goals. But remember, securing funding is just one piece of the puzzle. It's your vision and hard work that will ultimately drive the success of your startup. Exploring different funding sources gives you a broader range of options for raising the funds you need. Finally, be prepared for due diligence and negotiate terms wisely. Due diligence is a rigorous process that investors undertake before deciding to invest in your startup. They'll scrutinize your business plan, financials, market research, and legal matters. It's like a comprehensive health check for your startup. So, ensure your records are transparent, accurate, and up to date. Now let's talk about negotiating terms. This is a delicate dance where both parties aim for a win-win situation. Remember, it's not just about the money, it's about the conditions attached to it. Consider factors like control over decision-making, exit strategy, and the time frame for return on investment. Don't rush into agreements. Take your time, seek expert advice if needed, and negotiate terms that align with your startup's vision and growth plans. Being prepared for due diligence and negotiating terms wisely will help you secure the funding you need on terms that work for you.